Of course, we have to talk about it. Everybody is talking about it. Trump's comments about the 50-year mortgage. And so I wanted to just jump on here and have a conversation about some of the things that stand out to me as someone who's been in real estate that are going to come up that maybe you haven't thought of or maybe you have thought of. I was shown a house last night and a family was telling me about how much they were qualified for, and but they might wait because there's going to be Trump's going to be doing that 50-year mortgage soon, and so then they can qualify for more. First thing is, things like this don't just happen overnight. There are approvals that have to happen. These loan programs are going to have to be created. The whole loan packet of what to underwrite and what to sell them for on the secondary market, if they even will be on the secondary market, will they only be government subsidized? How is this going to work? This has to all be created. So if this does go into place, this isn't something that happens tomorrow. This is something that's going to take time. So just want to put that out there. Couple points. I have kind of like three main points that I want to talk about. First one is, and I think the last one is the most important and probably the one that most people, I've not heard anybody mention and most people probably haven't thought of. But the first one is, people do not always look at how they're going to pay over the life of the loan. One of the comparisons we're seeing is people will take the loan and the loan amount and extend it out and say, here's what your payment would be, here's what your savings would be. I look back to during COVID when interest rates were 3%, 2%, even some of them, and buyers were not looking at really the price hardly at all. They were looking at what their monthly payment was going to be. And we really live in a consumer economy, not talking about investors, just talking about the general public. We really live in this consumer economy where people just look at, what do I have to pay every month and can I afford that? And you see that by people getting a car payment. Every time they pay off a car, they get a new car. They don't just think, oh, nice, I have a paid off car. People are very comfortable in our society with debt, and they're not looking at the full long term, what is this going to cost me? What is my financial situation going to be? And so a big thing is that a lot of people don't realize, and I'm kind of averaging, I've read different close statistics from different places and from different mortgage brokers I've talked to, but most people stay in a home, I've seen anywhere from like 11.8 to 13 years is the average amount of time that somebody stays in a home. So most people are never going to keep a mortgage for that long. The big thing is going to be that they think the payment is going to be lower. The other thing is, most people don't even keep their mortgages that long. So I had a mortgage broker tell me years ago that on average, people keep a mortgage for about 7 years, whether that means you're moving, whether that means you're refinancing, and people refinance for different reasons. If you're scrupulous and you're an investor, you may be refinancing to pull cash out to invest in something else. You may be refinancing because that interest rate is better. A lot of times the consumer, the average homeowner in America who is not an investor, they're refinancing because they want to pull money out to spend on something else. They're not necessarily trying to time it as far as when's the best thing for my money and my numbers. And so anyway, 7 years. 7 years, I saw something else online that said 7 to 8 years is the average timeline that somebody keeps a mortgage. So when we look at this 50-year mortgage, people are not probably going to be holding on to these. Very rare that people hold on to these. They're going to be shifting and shuffling them around. So interest rates. Back to seeing the side-by-side comparisons. Everybody keeps saying that, you keep seeing these infographics where they compare them and they say the payment's not that much lower, but you're going to pay this much more interest over the life of the loan. And a lot of people are assuming that the interest rate is going to be the same. I don't see that there's any way that you get a loan that is 20 years longer and the interest rate is going to be as long as a 30-year loan. If you get a 30-year mortgage, the interest rate is this. If you get a 20-year mortgage, the interest rate is lower. And if you get a 15-year interest rate, the interest rate is even lower than that. The longer the term of your loan, the higher your interest rate is going to be because that's riskier to the lender. And so we don't know what this would look like. We don't know how much higher it would be. But if you were going to get a 15-year loan, if they do create that mortgage product, there is no reality where that interest rate is going to be the same as a 30-year product. So something to think about. Maybe even higher fees, maybe even higher closing costs, because again, the lender has to defer that risk as much as they possibly can. Here's the big one. Here's the one that I have not heard anybody mention and I think is the most important. Investors keep talking about how because some investors really focus on building equity and some investors really focus on cash flow. And I have heard cash flow investors focusing on, well, if it's longer, I don't care how much somebody else makes off the loan. To me, the most important thing is my cash flow. And if my cash flow can be better, that's more liquid money I have to invest in other things. I don't think this loan will be available for everybody. If they create a 50-year loan, just like some of the first-time homebuyer programs, just like some of the USDA home programs, there are income requirements or there are parameters. And so when I bought my first home, when me and my husband bought our first house that we were going to live in, we were never allowed to use any of the USDA or first-time homebuyer products that are available in my area because I had other investment properties. When I look at in my area, we have something called a rural development loan. It's a no money down loan. It's meant to stimulate home buying and the opportunity for being a homeowner in lower population areas or lower income areas. And to me, the income limits are still pretty high. I think you can make like $94,000 a year and still do these first-time homebuyer loans in our area. And the more dependents you have, that income allowed goes up. And so we could not ever use those because we had other investment properties. So here's the thought process. So these rural development loans, you can't buy an income producing property. So you can't buy a duplex, can't buy something with a basement apartment. You have to buy a single family home that you are going to own or occupy. If you move out of the home, I don't know if you only can live, you have to live there a certain amount of years and then you can use it as a rental property. But I think with these RD loans, you actually have to refinance. I don't think you're allowed, and don't quote me on that, I'm not for sure. If you're a lender and you know about rural development loans, comment below. Is there actually like a requirement where you can live in it 2-3 years and then move on? Or do you have to refinance if you wanted to keep it as a rental? That one I'm not sure of. But I bet if they do a 50-year mortgage, you are not going to be able to use it for an investment property. It's going to be for first-time home buyers, lower income home buyers. This is going to be to stimulate home buyers, home growth for people that maybe it'd be harder to attain a home. I don't think it's going to be available for everybody. The other thing about this is I think the people it's going to hurt the most are the people that need it the most. And so there are so many different loan things and mortgage things and opportunities for investors that if you do your research and you're scrupulous and you are educated and informed, are great programs. For people that really need them and they're not doing the research or they're not understanding what they're agreeing to, this is where it hurts. So if you buy a 50-year mortgage, you buy a home on a 50-year mortgage, your principal is going to get paid down very slowly. And so you are going to owe more on the loan for a longer time. And you know, going back to my experience with the first-time home buyer loans in my area, watching clients use those, a lot of times they have these extra fees they fold in. Again, it's higher risk to the lender. So the lender is going to fold in as much as they can. And so sometimes when you do these no money down loans, you actually end up borrowing more than the purchase price of the house. If you unexpectedly have to sell that home in a year, say you relocate, say you get a divorce, say you lose a job, you have no equity in your house. You may actually owe more or close to what you bought the house for. And then selling a house isn't free. Even if you do a for sale by owner, you're going to have to provide title insurance, probably going to be some repairs you negotiate in, maybe some buyer credits. And so if somebody buys a home with a long-term mortgage, they haven't paid down the balance and they have to sell quickly and they don't have cash on the side, are they going to have to foreclose on these homes to get rid of them? Maybe they're not going to be able to rent them. So how are they going to get rid of them if they have to sell them and they borrowed more than what they purchased them for, and then their equity is just non-existent. So these are just some things to think about. When I remember back to COVID and they were doing all the deferrals where there was an opportunity for people to not make their payments for a certain amount of time, but the interest still accrued. I keep hearing the title company talk about these because we have people selling their houses now and they've assessed them as second mortgages on the back end of their mortgage, or they didn't understand. The title companies keep telling me, these lenders made this seem like a really good thing to consumers and they didn't explain them. And it's up to you to do your own research. The borrower did not do their research and look into it. It just seemed too good to be true, which what's the adage? If it's too good to be true, it probably is. And so I've had people that go to sell a home thinking they owe this much, not understanding what that second looked like or what that deferral looked like, and really being in a tough spot and either not being able to sell, considering letting their homes foreclose, or realizing, man, I have to sell my house for a lot higher and I don't know if I can because of that interest that we let accrue during that period that we didn't make the payment. The other thing is, a lot of people took those deferrals on. I've had people tell me I didn't even need to do it. They just told me it was okay and there was no consequences. So I just did it. I just didn't pay the payment when they didn't make me. So are there going to be people that take the 50-year mortgage that it looks better, they think it's better, but they don't need to, and maybe it's not the best scenario to them, but they're going to do it anyway? The only other thing I want to say is I've heard people say a couple $100s a month isn't that much. It doesn't make that much of a difference. If you have the money, it's not that much. If you don't have it, a couple $100s is a lot. It could be the difference of buying a home or not buying a home. It could be the difference of qualifying or not qualifying. It could be the difference of your groceries or not having your groceries. So this may create the opportunity for home purchasing for first time or lower income home buyers that it would not be attainable to them otherwise. I just hope that there is some sort of a requirement of education. Like sometimes if you get a first-time home buyer loan, they have a first-time home buyer course you have to take to get that loan. I hope there is a small education caveat here, because I think it could be a good thing for people that really need it, but I want to make sure that it is explained to them in a way that people understand the implications and can make an educated decision if they don't have that information. One more point I forgot to mention that I think is actually really important is, does this inflate our housing prices even more? Because right now, our housing issues are, it's not like 2008 where there was overbuilding or, unscrupulous lending or subprime lending or anything like that. We still have a housing shortage. It's just that we have an affordability problem. So there are buyers that want to buy homes. To me, this is like printing money. It's almost like, what was that show, Whose Line Is It Anyway, where they're like, where the points are made up and the score doesn't matter. This is like fake money, because most people are never going to keep these loans this long. But what it does is it makes it where people can borrow a little bit higher, whether they want to or not. And then just like the low interest rates drove the housing prices up, we're still with this complex problem that economists smarter than me have to contribute to figuring out. We're not fixing the problem. Yes, we're making houses more attainable a little bit for some people, but is this gonna make the housing problem worse, just like the low interest rates did in the long term? And that's my concern. So that would be my only warning sign on this. What are your thoughts about it? What are the pros? What are the cons? Do you think they're gonna do it? Do you think they're not? And do you think it helps? Also, do you think they're going to have it available for everybody, or is it going to be first-time home buyers, lower income home buyers? What are your thoughts about the 50-year mortgage?